So this is the part 2 of venture capital. So welcome. Before getting into venture capital, I just wanted to tell you that many of you would be knowing about Blackrock, which is the biggest asset management company in the world. They manage $11 trillion as of 2025, and which is like US GDP is $30 trillion, and BlackRock manages $11 trillion. US wealth is 130 trillion. So wealth and GDP is different things. So they are into wealth management business. So I'm trying to tell by this example is the funds world is so big, like the funds, venture capital fund, hedge fund, private equity funds, mutual funds. So BlackRock has every division: hedge fund division, VC fund division, mutual fund division. So they are managing $11 trillion of assets under management. So this is the biggest company in the world. So like this there are many. Second one is Vanguard, then Fidelity, State Street, and many are there. So what I'm trying to tell is, in the game of capitalism, this is the game of all games, like the funds game. So basically, that's why it's very important to learn these concepts if you want to become wealthy in future. So let's start with the video. So venture capital funds operate under a limited liability partnership or private limited partnership. So the legal structure I'm talking about. So this is how it works. So there is limited partners who invest. They are 99 in numbers, or it can vary. But before moving forward, there is a disclaimer that my knowledge is limited and the information which I share is based on my current understanding and learning. So I can be wrong at times, and I welcome open discussions and corrections in the comments below. So they can vary according to the laws in the country, like in India and US. But let's take 99 or 100 limited partners in this example. They can be pension funds, big institutional investor, or family offices which invests in the venture capital fund. So venture capital fund is a pool of money, and the minimum investment per LP limited partner is 1 crore. So 100 limited partners invested 100 crore in this fund. So this is a micro VC fund. Then there is general partner who manages these funds by investing in startups, and this fund runs on a model of 220, which is 2% management fee and 20% carried interest, which we will discuss in later part of the video. Now these funds invest in 50 companies, out of which even 10 becomes successful, then their job is over. And if 40 fails, it doesn't affect them that much because these are high risk, high reward investments. So we will discuss how these 10 companies return the entire capital and the return over that capital. So let's first discuss how the fund life cycle is. So this VC fund is generally a close-ended fund, and its life cycle is of 10 years. So the first 1.5 year is called as the capital raising phase, in which the fund manager, which is the general partner, who raises money from the limited partners, which are big institutions, pension fund, family offices. So 1.5 years is the capital raising phase. Then the 1.5 to 5 years, which is marked in yellow. So this is the capital deployment phase, in which the general partner who is managing the fund deploys the capital in 50 startups. And then there is a monitoring and tracking phase, which is marked in red. So here he will monitor the companies in which he has invested, the startups. And then this is the harvesting phase, the marked in green. So here he will sell those startups and he will book the profits. And this is how the 10-year fund life cycle is structured. We will discuss in detail in upcoming playlist, like the series of videos which I am going to make on venture capital. But for this video, this much you need to understand. And this is a close-ended fund. So once the limited partners invested in the fund, then they will have to wait for 10 long years to get their money back, and they will make a good return on it, usually between 15 to 25%, which is a good return. Now let's discuss how these funds return the money to the LPs with the 25% return on capital. So let's say 100 crores we were discussing in our fund. How that 100 crore turns into 1000 crores, that we are going to discuss here. So this is called as IRR in venture capital. That is 25% IRR they have to generate, let's say. So the 100 rupees has to turn in 1000 rupees at 25% compounded rate, which is you can also call CAGR, compounded annual growth rate. But in venture capital world, it is called as IRR, which is a complex formula which has a lot of things in it, like the present value of all the cash flows and everything they need to take into consideration. But for our example, we will take it as 25% rate they are compounding the money. So 100 rupees will turn into 1000 rupees after 10 years. So they are investing in 50 companies. 10 will give all the return, 40 will fail. So two companies, first of all, two companies will return 100x return. 4 companies will give 50x return. 6 companies will give 15x return. So what is this x? First of all, we'll discuss. X is equal to times also you can say. So 1 rupee becomes 100 rupee, then it is called as 100x. If 1 rupee becomes 50 times, that is 50x, then it is 50x return. So we are going to discuss about the 10 companies which are going to return all the money, entire money and the return. So we have to turn 100 crore into 1000 crores in 10 years. That's when 25% return is generated. So 2 companies out of these 10 companies might become so big that they become 100 times. So average VC fund is investing 2 crore in our company because we were managing a 100 crore fund and that was investing in 50 companies. So average they were investing 2 crore in each company. So now 2 companies will return 100x return, so it will be 200, but in each company we are investing 2 crore. So 2 companies would have taken 4 crore in investment, which has turned into 400 crores. Then 4 companies which are returning, let's say 50 times, so it becomes 200, but as we were investing 2 crore in every company, so 8 crore was invested, which turned into 400 crores. Then 6 companies in which we invested 12 crore, 2 crore each company, they returned 15x return, so it turned into 180 crores. So this is how the 10 companies have returned 400 plus this 180. So they have returned in total 400, 400 and 200. So 1000 crore total they returned. So this is how the return on capital is made. 100 crore turns into 1000 crore in a 10-year time. So the fund life cycle is 10 years as we discussed earlier. So this is how it works. So now we have understood how the general partner turns 100 crores into 1000 crores at 25% IRR, which is internal rate of return. So he makes 900 crores in profits. 100 crore turns into 1000 crores, so 900 crores is the profit. So how these get distributed? So 20% of 900 crores will be taken by the general partner, which is called as carried interest, and 80% of the 900 crores will be returned to the LPs who have invested in the fund, the 99 number of LPs. And this fund charges 2% management fee every year, which is 2% of the 100 crores, which is 2 crores is charged every year to give the salaries of the team which the general partner has below him, and also the salary of general partner which he takes every year. But after 10 years he will take the 20% carried interest of these 900 crores. That's how he makes huge money, and that's why this is lucrative business to start. And that's why this structure is called as 220 structure. That is 2% management fee and 20% carried interest. So that's why it is 220 model. Now some of you might be wondering that is this even possible to generate 100x return or 50x or 15x? That is, a company which is doing 1 CR in revenue should turn into 100 CR in revenue. That's when a company becomes 100 times. So is this even possible? So to know that, you can watch my video on how startup scales. That is where you will understand these concepts, and it is possible to make this kind of return. And that's why these investments are called high risk high reward investments, where 40 companies will become zero or not even return less than 1 time 2 times of investment, but the 10 companies will return entire money with the return on it.